Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy with all the monthly ETFs. And today we're diving into one of the most complete walkthroughs I've ever done on a single ETF family. We're breaking down the entire Global X monthly paying high income ETF lineup. What they do, how do they make their money, where the risks are, and what type of investors should each fund actually fit. If you're a retiree, an income-focused investor, or someone looking to build a predictable monthly cash flow, then this presentation is to help you understand exactly what Global X Income Engine works. Before we get into it, I got to do a shout out to all of our Patreon supporters and all of our YouTube subscribers. Without you guys, we would not be doing these videos. Also, got to be a shout out to all of our new YouTube members. These are the guys who are helping support the channel. If you want to support the channel, look at YouTube or look at our Patreon. Either way, it helps the channel and we appreciate it. If you're not a member, hit that subscribe button, hit that bell notification. It's so simple, easy to do, and it helps the channel grow. Let's get into today's video. And before we start, a quick but important disclaimer. Past performance does not guarantee future results. Everything in this video is for educational and informational purposes only. This is not a financial advice. Always speak with a licensed financial advisor before making any investment decisions. These examples and illustrations are only, and the investor situations are always different. All right, with that out of the way, let's dive deep into this presentation. One of the most popular segments of Global X lineup is the Covered Call and Growth Series. These ETFs use a hybrid income approach that mixes two things. One, a 50% covered call overwrite and a 50% pure equity exposure for growth. This is really important. They're not selling calls on the full portfolio, only half. So you get the upside potential while receiving meaningful monthly income. This middle ground strategy works well for moderate investors who want higher income than simple index funds provide, but don't want long-term NAV erosion that can come from 100% overwriting strategy. We'll review each of these in the series next. So let's start off with the Covered Call and Growth Series fund analysis. And the four key Global X Covered Call and Growth ETFs are the QYLG, RYLG, XYLG, and DYLG. Now the QYLG is for the NASDAQ 100, the RYLG is the Russell 2000, the XYLG is the S&P 500, and the DYLG is the Dow 30. Now, most of these all operate the exact same process in the same way, doing that 50-50 covered call split. So let's break down QYLG first. It currently shows that it has the highest yield, and you can see on the screen 24.59%. But remember, NASDAQ is a tech heavy and brings high volatility. Now we look at them and we see $124 million under asset. And the big thing is they've had the big dividend growth. When we look at RYLG, now this one has the strong return, 23.83% yield, but has the smallest assets under management in the big three, which raises the risk of liquidity, especially during stressful markets like we see today. Their assets under management of 7.7 million, you can see, is below the NASDAQ 100 and below the S&P 500. Now, they have had again dividend growth of 186%. We go to XYLG. Now this offers a nice balance, large cap exposure with a solid yield and a decent dividend growth. It's like a happy medium. They have the largest growth across the board, but they're also in the middle of the road on assets under management, and they're right there with the yield of 23.55%. The assets under management at $58 million, and then that dividend growth of 378%. Then we look at the DYLG, which tracks the Dow, and it gives you exposure to blue chip companies, but has, we'll say an extremely small asset under management of 4 million, and the yield is 16.45. Now they have been slowly growing with the dividend growth with 387. So your key takeaways here are the QYLG is for the growth-minded investor seeking comfortable with volatility. XYLG is the most balanced in the group. And RYLG and the DYLG carry significant liquidity risk because of that low assets under management and work only for high risk income seekers. So out of this whole package, the real two winners are QYLG, XYLG, because, like I said, they have the higher assets under management, they have good yields, and they have some decent growth in the dividend. Now the yield comparison charts that we have, I wanted to show you when we compare everything side to side, you'll notice virtually three things. One, every one of the funds dropped on April 2nd when the tariffs announcement came in. And virtually every one of the funds recovered out of the April 2nd drop-off. And you can also see that they're almost exactly same patterns across the board. So the NASDAQ 100 and the S&P 500, you could almost lay those on top of each other and have a matching set, similar to the Russell and the Dow. Now, the only kicker in the whole mix is going to be the Russell 2000, which has actually had a 3.8% loss year to date. And that's primarily from just the last 2 weeks in the market, while everything else has held to stay positive at 3.63, 2.89, and 4.01. So when you're evaluating these, just don't chase yield. Look at every part of it: the long-term stability, the growth exposure, the liquidity, the assets under management. There's a lot of information that we just put on the screen for you to take a serious look at. And when you do your own research and you do your own decision making, these are the pieces that you need to use. Now let's move to the pure covered call series overview. Now, this is going to be, many retirees probably know this one extremely well. The funds overwrite 100% of the underlying portfolio, meaning they sell calls on nearly every share that they have into the program. And that's the difference. From the last one we looked at was 50-50. This is now 100% on the covered call. This gives them a very high potential consistency in monthly income, but there's a trade-off, which is the limit to the upside potential and the long-term possible NAV erosion. Think of this as a stable income engine that works beautifully in sideways markets but underperforms significantly during strong bull markets. So when the market is really rising, these guys are not going to rise. These are going to they're going to hold back because they got the capped up their upside. But when the other markets happen, they're generally doing a better performance across the board. Now let's talk about the pure covered call series and the fund comparison. Now these are the funds you probably have already heard about or know about. They've kind of become quiet a little bit because they're just the old-fashioned style funds. The QYLD uses the NASDAQ 100, the XYLD uses the S&P 500, the DJIA is the Dow 30, and the RYLD is the Russell 2000. So very similar to what we just talked about. Now, when we go through each one of them independently, let's look at this. The yield of QYLD is 12.89 with the assets under management of $7.93 billion. This is one of the largest global X funds and uses the growth rate of about 5.9% on the dividend. So we have a massive asset under management, and then we have the potential of a stable income. XYLD is the S&P 500, giving you a solid 12.87% yield, and then an asset under management of just under $3 billion. And that's one that had a dividend growth of over 33%. So this gives you a better NAV stability and a good distribution rate growth. Now the Dow 30 gives you that 12.66% yield and an asset under management of $136 million with that 84% dividend growth. So higher monthly income potential, lower volatility, and then the Russell 2000 does the same thing. We have a 12.5% yield, $1.21 billion in assets under management, and now they have struggled with their dividend growth, down 5.43%, but they still generate a good potential income, and they're working with the small cap exposure. Now, the number one risk these funds employ is 100% covered call overwrite, which is capping the upside. So when the markets rise, these funds shares at the stake price, they're missing the capital gains and premiums. Often they do not offset the missing appreciation. So we always say these are best for investors prioritizing income withdrawal over a long-term capital growth. It thrives in those sideways markets that we talked about. These funds may make sense for some retirees depending on their goals, their risk tolerance, and personal situations. But if you need growth and you want to do the hybrid funds instead, and this is the neat part about Global X, they offer you both. They offer you of what you can understand and how to use it. They give you the opportunity to work inside of one family. Now we take a look at the breakdown of these funds. So the QYLD, and again, we're going to go over this, the three things to look at. Look at the patterns. They're almost identical to each other. They've all struggled together. Okay, this is that 100% call option. Look what they've done. They've not have recovered as well from April 2nd as the other funds have done. So you have a down 5.93. The Russell is down 8.81. The XYLD is down 5.20. And the Dow Jones is down 1.18. But it's funny how the patterns, when you use the same system over, even in all the different categories of the Russell and the NASDAQ and the Dow and the S&P 500, they look identical. They all operate the same way. So the risk management of income series. So the risk management income series include QRMI and XRMI. These funds use the call, it's called a net credit collar strategy. Okay, what this does is provide downside protection while generating income. So it sells call options for income, uses the premiums to purchase out of the money put options, and it limits the potential losses to a typical less than 5%. So this gives you the benefits of two things, a potential monthly income and built-in downside protection. Losses are generally limited to that 5% as I talk about during major downtrends. However, there is a trade-off. The protection reduces overall returns. So these are great for conservative investors who fear sharp declines but will want monthly income. We look at what they offer. QRMI is the NASDAQ 100, and it does the 12.57 yield with an assets under management of 16 million, a growth dividend of negative 2.95%. The S&P 500 version does 12.62, $43 million in their assets, so almost literally 3 times difference, and the dividend is declined by 2%. We take a look at their charts, and again, I can't express this enough. When you use the same philosophy between the Dow, S&P, they all come out looking very, very similar to each other. So you can see both of them are down by 8%, 8.84 and 8.24%. And I do clearly want to say that these numbers are only a snapshot of the day that we took the video. These things will change by the day, by the hour, by the minute, all by the stock market doing what it does. So now let's go to the specialty and sector income funds. Global X also offers specialty income ETFs like MLPD. It's the Energy Infrastructure Covered Call Package. And you can see their yields from 11.56 with the assets under management of $12 million. This is a strong income from the energy sector. SDIV is the Global High in Dividend Stocks. This is a large assets under management of $1.04 billion, and it's an international diversification. The yield comes in at 9.75%. The ALTY alternative income, this is alternatives, 8.20% with a $38.8 million assets under management. This is good diversification with growing dividends. And SERT is the REIT. It's the Super Dividend REIT ETF. Now, this one has strong monthly income with the real estate focused 8.18% yield with a $204 million asset under management. Now, all of these do have some different risks. Some have the assets under management is very small, so you got liquidity risk. Some have dividend shrinkage and distressed holdings. Some are with interest rate sensitivity. But overall, these give diversifications beyond traditional indexes, but each come up with their unique risks. So we really have to watch and use these, and these can be very powerful tools, but if you understand each sector cycle. When we take a look at these funds, now you're going to see a little difference, but not a lot when you look at them across the board. So you look at the energy side of it, it was down and then it's come back up. It's down 1.6% for the year, but every one of these, I will first make note, they all came out at April 2nd, completely high. And so they've recovered from that point. ALTY 1.9, but SDIV 14.74% is rocking for growth this year, doing very good. So it's even higher than it was at the April 2nd drop off. And then the real estate at 7.27%. Now let's talk about the preferred stock series. The preferred stock series are a hidden gem for many retirees. The Global X preferred lineup includes PFFV, the variable rate, the DIV high dividend, the SPFF sector heavy, and the PFFD large U.S. preferred funds. And you can see on here the rates between 6.51 to 7.7%, and these funds typically have lower volatility than the actual equities. The key risk here is interest rate sensitivity, especially for fixed rate preferred stocks. But overall, these ETFs offer a conservative, steady monthly income potential across the board. When you look at the assets under management, the preferred U.S. PFFD is at $2.26 billion. And it is interest sensitive. When you look at the just across the board, they're all 129 to $600 million in assets under management. So these are very strong little pieces, part of the Global X Fund. And when we take a look at their background, now they've struggled a little bit lately as you're looking at the down 4.94, 3.86, 3.0, and 4.74. They're not all as common as we've been seeing. They all dropped in the April 2nd. They've all come out, but they've never really recovered back to where they were originally. So these guys take a little longer time to redevelop what needs to be happen. Now let's go to the emerging market bonds, EMBD. It is the Global X Emerging Markets Bond ETF. It offers a respectable yield above 6% and exposure to the global income fixed market. But the emerging markets come with higher geopolitical risk, higher currency volatility, and deeper drawdowns during global stress periods. The fund is a very specific investor, someone who wants yield and diversification and can tolerate volatility. It should not be a core of a conservative income portfolio. The risks that are out there, as we talked about, is that geopolitical. You don't have control. You don't know what's going to happen if a country decides to do whatever it decides to do. But it's a dividend trending upward part. $271 million in assets under management with a 14% growth in the dividend. There's some potential there, but as we always say, it's a bond and you're fluctuating through it. So the ETF section framework, choose the right Global X ETF, and it starts with a simple framework. What's your objective? Income, growth, downside protection? What's your risk tolerance? Conservative, moderate, aggressive? What is the fund health? The assets under management, the dividend consistency, the sustainability. This process helps eliminate funds and you don't what won't fit into your focus and into your portfolio and to what you do. So these are the things that you really got to look at. And I put this on. This is probably the most informational piece of the video is how do you pick one? Is you got to know what it is in your health and yourself and your portfolio and what you want for long term. I talk to a lot of different people and everybody's different. There are really almost no two people the same. But we try to put you in. Do you want balanced growth and income? Are you looking for the home runs, which is the yield seekers? Are you looking for conservative income? I just want it simple and easy. And then people want the income first for retirees. And there's funds for each and every one of these that we can pick out. So I always say this way. You need to match what fits you. And here's how I break it down. If you're an income first retiree, you're going to want that QYLD, XYLD, the PFFD, and the PFFV. So these are your pure covered series and your preferred stock ETFs. Okay, if you're going to be a conservative investor, which is going to give you the XRMI, the risk managed series, and the QRMI, and then you're going to want the variable rate preferred, which is the PFFV. If you want balance with growth and income, and that's going to give you that covered call and growth, QYLG and XYLG. And remember, as I told you earlier, how those things all pattern each self because you're using the same pattern. And then the alternative income is ALTY. You want that in a balanced fund. And then the yield seekers, comfortable with that higher risk, someone who's trying to hit the fence with the home runs, that's the RYLD and the YRLG. And then, of course, the emerging market bonds. This helps you match the right ETFs with your personal strategies, not someone else's. Now, this is all just examples. These are just, none of these are set in stone. You get to make the decision. It's not that I have any insight either which way, but these are how these funds all fit and how we do it across the board.
Thank you for watching. Press the like